Flags. So in the first half of the lecture, we have talked initially about continuation patterns generally, and then we spent some time talking about triangles, which are the most common type of continuation pattern. Now we will look at some other types of continuation patterns. So we'll look at flags and pennants, then we will look at rectangles, and finally we will look at the continuation head and shoulders. So let's first talk about flags and pennants, and then we'll talk about flags on its own. So flags and pennants represent continuation patterns that follow a large market move. So they are situations where the market has gotten ahead of itself following a large move, and it's catching its breath before moving in the same direction. So normally it'll be a significant uptrend or downtrend, then a pause, which creates the flag pattern or the pennant pattern, as we'll discuss in a few slides, and then it continues in the same direction. Alright, so let's first talk about the flag. Now the flag will consist of two parallel trend lines, right? So these trend lines will not meet, they're parallel, and the slope of these trend lines will be against the current trend, right? So what that means is that in an uptrend, we will have a downward sloping flag. In a downtrend, we will have an upward sloping flag. And so let's imagine what an upward sloping flag would look like. So we'd have a large upward spike in the price. Then we would have the price staying between two parallel lines going down, right? Because the lines are downward sloping, right? So it would fall, and then it would break out and resume the prior uptrend. Right, let's now quickly talk about volume. Now, the volume implications are fairly similar to what we've been discussing so far. So the large move prior to the flag taking place should have high volume, that is the significant uptrend. Then during the flag pattern, volume should be low. This is the consolidation, or this is the market catching its breath, taking a breather, so to speak. And then the volume should increase again when the price continues upwards following the breakout. Okay? Now, flags tend to be shorter term than the triangles we've discussed. So we'll come to this a little bit later as well, but in general, a flag will occur over a shorter time period, as will a pennant occur over a shorter time period than the triangles. So now what we will do is we will look at an example. Actually, we will look at a diagram first, and then after that we will look at an example. Flags, diagram. Now here we can see the diagram of the flag. So now we'll go through this a bit because it's slightly different to the triangles we looked at before. So first, I want to just look at the price movement. So we have the price making an upward movement. So this is a sharp upward spike before this pattern. Then we have a peak here, a trough here, a lower peak, a lower trough, an even lower peak, and an even lower trough before the price breaks out and continues on its upward trend. So what are the important things to know here? Well, both these lines, okay, are parallel to one another. And also both of them are downward sloping. So what we're actually seeing is that following a sharp upward move, there's going to be a general downward fall in the price, and it can be represented by two parallel trend lines that are slightly downward sloping, right? Falling peaks and falling troughs. But the important thing to know about this pattern is that it will then break out to the upside, right? So even though we have these falling peaks and troughs, as long as we have the volume indicators that confirm it, that is volume increasing here, volume lower at this part, and then again the breakout, volume increasing on the breakout, we have these confirming patterns. The market is really just here catching its breath before carrying on its prior trend. And this is a flag. And the flag is essentially made by sort of this line here, this one line here, and these two lines here kind of make a flag, right? So that's where these names come from. Let's now look at an example. Flags. Example. So here we have a new graph. This is the NSE Nifty Index from April 2010 until September of the same year. And what we are going to do is show you a flag pattern on this graph. So the peaks and troughs I'm going to use this trough here, this one here, and these peaks here, and as well as this trough and this peak. Okay? So now I'm going to draw the flag, so it will look a bit like that. It's a pretty narrow flag. And what we have here is that the price has made a fairly sharp upward move. Okay? It enters into this flag pattern where it makes peaks and troughs that are descending, as evidenced by this. And then after that, it breaks out over here and continues upward. So again, as you can see, this is not a completely exact pattern, but it is a fairly good representation of what a flag pattern should look like. So the prior uptrend here, the falling peaks and troughs here, these two lines being parallel, just about, followed by a break off to the upside. And then we can see here that the uptrend continues onwards as we would expect. Alright, so this is now what a flag looks like. The next thing we will go on to discuss are pennants, which are similar to flags with a couple of minor differences. Pennants. Pennants occur in identical situation as flags do, but they have a different pattern formation. So the reason we talk about pennants in combination with flags is that they have more or less the same situation. Right? So they will follow a large spike in the price, either up or down. So just one thing to note about the previous example as well is that a flag can also be downward. So you can have a large downward spike, a slightly upward sloping parallel trend lines, followed by a continuation of the downward trend. It can go both ways. Same for a pennant. So the pennant situation will be identical to the flag. The only difference is that the pattern made in the consolidation period will be different. Right? So in the flag, the pattern was formed by two parallel trend lines sloping in the opposite direction to the major trend. In a pennant, it will actually look like a small symmetrical triangle. So rather than a flag shape being made, we'll make a small symmetrical triangle. And other than that, they are essentially identical to flags. Their implications are the same and the setup is the same. Alright, and that's why we can refer to them together. Now, what are some of the key differences between flags and pennants and triangles? We alluded a bit to this earlier. Okay, the main difference is that flags and pennants occur over much shorter time frames. Triangles occur over longer time frames. Triangles can be up to 3 months, as we said before. They can also be short, so any of these patterns can be short, but really we're looking at how long can these patterns go on. So while triangles can go up to a period of 2-3 months, flags and pennants usually are measured in weeks. So we'd have 3 weeks, 4 weeks, or less for a flag and a pennant. And this is because usually it's a sharp upward move, consolidation, another sharp upward move, or downwards as well. The point is they're a sharp move, so the market's moving quickly. And hence we have this type of consolidation pattern. Now, what are the key differences between an uptrend and a downtrend as for flags and pennants? So the example we showed of the flag earlier was an uptrend. But as we mentioned, flags can also occur in a downtrend. So the main difference will be is that when we have a downtrend, the flag will usually be smaller, shorter. As with the pennant, they'll be smaller and shorter. So the consolidation period will be less before it continues downwards. Now for both flags and pennants, we complete the pattern following the breakout. Right? Breaking out of that pattern, that completes it. And that's the case for all the patterns we've been discussing. Alright then, so let's go on to look at the diagram of a pennant, and after that we will look at an example of a pennant. Pennants diagram. Here we see the diagram of a pennant, and we'll just go through this. So we have here the sharp upward move, okay? And then instead of having the parallel lines going downwards, we have essentially what looks like a symmetrical triangle. The main difference is that it's smaller. We have the falling peaks made by the price, and we have the rising troughs made by the price. And this then leads to a breakout to the upside and the completion of the pennant pattern. Now, why is it called a pennant? Well, this shape here, this one line here followed by these two trend lines, looks like a pennant, hence it's called a pennant. So we can see that the situation is identical to the flag setup. We've got a sharp upward move, consolidation period, followed by another sharp upward move. The main difference, of course, is that this consolidation period looks like a symmetrical triangle instead of two parallel downward sloping lines. Now, what is the difference between this one and the symmetrical triangle? Because it actually looks very similar. If you go back to the symmetrical triangle diagram, you'll see that it looks almost the same, actually. So the main difference is that the prior uptrend is much quicker, right? So it's much more of a sharper move, as is the breakout to the upside, and it's a shorter time period. So when we have sharp moves and shorter time periods, then we're dealing with the pennant. If it's a longer time period, not a sharper move, then we're dealing with a symmetrical triangle. Either way, the implications are probably the same. And again, with the pennant diagram, we can have it going the other way. So we could, for example, have a downtrend here coming this way, followed by this pattern made, and a downtrend going that way. So there's no reason a pennant can be going downwards. Alright, let's now go to an example. Pennants example. So once again, here we have the Nifty index. We've gone now to an earlier time period. This will be from February 2009 until about the middle of the year, just past July. So now I'm going to draw you a pennant on this graph. And if we go to the middle of the graph here, I'm going to use this peak here, that one there, and these two troughs. Okay, so if I draw, and this is my prior uptrend, so if I draw like that, draw this like that, okay, this then creates my pennant. Now, it's slight exaggeration because these two peaks look like it very close to the same level. Actually, this one is slightly lower than that, so we can draw a pennant, the downward sloping uptrend line. And then we draw this one, which is fairly clear. And what we see is that we have a fairly sharp upward break here, going up here. We make the pennant pattern, and then we have another sharp upward move. That is the breakout. Right, so this follows the pattern we expect for a pennant. Essentially, it's a small symmetrical triangle, but shorter and with a sharper move initially and a sharper move afterwards. So we have the sharp uptrend, and then the price sort of continues to go up for some period afterwards. So that's a pennant, and now we've discussed flags and pennants, and hopefully we got a sense of what these are for. Again, in our examples and diagrams, we've only showed them going upwards, but you can just as easily find them going downwards. And I encourage you to try and find a downward sloping flag and pennant in your own spare time. And now we'll go on to discuss a couple of more patterns. We'll talk about rectangles, and then we'll talk about the continuation head and shoulders. Rectangles. The next continuation pattern we will discuss are rectangles. Rectangles are a fairly commonly observed pattern. They're also fairly simple. They are a bit like the flags that we discussed. Now, rectangles represent a pause in the trend during which the prices move sideways between two parallel horizontal lines. So again, we're going to be dealing with slightly longer term patterns here, so think in terms of triangles rather than flags or pennants. So if we think about the triangle as where we have two converging trend lines, alright, with a rectangle we're going to have two parallel trend lines. So the peaks and troughs that the price makes will create two parallel trend lines. And that's essentially the main difference between the rectangle and the triangle. Otherwise, they're fairly similar. And rectangles are often referred to as trading ranges, right? So when the price is trading within a range, okay, that can also be the rectangle. And the rectangle as well will also be the support and the resistance, right? And again, as we mentioned, they're similar to symmetrical triangles, except that trend lines are flat instead of converging. Most of the time, rectangles represent continuation patterns, right? So a rectangle will represent a pause in the trend before the trend continues in the same direction that it was before. There are occasions where a rectangle will mean a reversal in trend, but a continuation is more likely than a reversal. So what completes the rectangle pattern? Well, in general, if we have a breakout outside either of the trend lines, whether it's going up or down, and again, we can talk about using bands here to avoid whipsaw with this as well as with all the other patterns. And so a break outside the trend lines will represent a change in the trend, right? So that will be the direction of the trend once it breaks out. Now the nice thing about rectangles is that we can use them trading wise for two different purposes. So with most of the continuation patterns we've talked about, we're generally interested in trading the breakout, right? So we're interested in trading the point where the price moves out of the pattern, out of the triangle or the flag or the pennant, and carries on in its previous trend and trading at that time. Now we can do the same with a rectangle, of course. But the other thing we can also do with a rectangle is actually trade swings within the range. So if we have a fairly large rectangle that the price is bouncing off of, we can buy at the bottom of the rectangle, sell at the top, then buy again at the bottom, etc. So we can actually trade the range in addition to trading the breakout. So this is one of the nice things about rectangles. Whenever you find them, they represent pretty good trading opportunities. So let's now look at the diagram, and we'll look at an example after that. Rectangles. Diagram. Here we have the diagram of a rectangle. Again, this should be not too difficult if we have successfully understood all the previous diagrams we have done. So here we have the prior uptrend. Okay, the price is going up here, right? It makes the peak here, then comes out and makes a trough, then makes a peak at the same level as before, as the prior peak, then makes a trough at the same level as the prior trough, then again a peak at the same level as the prior peak, and a trough at the same level as the prior trough. And following that, there's a breakout to the upside, going here. So what are the key distinguishing features? Well, these two lines are flat, they are horizontal, and they are parallel. That's what makes it a rectangle. Now, as we mentioned, we can use it to trade the breakout over here. We can also trade the range. We can sell it up here, buy it down here, sell it here, buy it here, etc. So rectangles can be used for two purposes. And again, this is an upward sloping continuation pattern. We can also have a downwards continuation pattern. If the price started here and came down, for example, it would do the same thing and then carry on downwards here. So we can have up or down with a rectangle. Let's now go and look at an example. Rectangles. Example. Here we are back to our graphs, and this time again we've gone with the rupee against the dollar. This time period is now starting of 2009 until just past the middle of 2009. And what we are going to do is find a rectangle pattern that follows on, shows us a continuation of the prior trend. So here we have the two peaks I'm going to use for the pattern. It's not going to be exactly parallel, but we'll just go with what we have. And the troughs I'm going to use are one here and sort of this one, it's kind of a largest trough here. Alright, so if I draw this rectangle, I'll get this, and then I will get this. Right, now pardon my drawing, this is not the best drawing, the lines do not look parallel, but just assume that they are. And what we see here is that the price here is on a downtrend, right? It's starting up here, it's coming down, it's coming down, it's going into the rectangle here. It's making the trough here, making the peak here, making the trough, making the peak, all at around the same level, right? And then the price is breaking down, going down, alright, continuing its prior trend. Now what's interesting here is that this line here now becomes the future resistance level, and we can see the price nearly goes up to this resistance level before going much further down. Alright, so this is an example of a rectangle. Rectangles are fairly common in financial markets. If you look around for them, you can find them. This one is sort of more difficult to trade the range, given that the range is quite small. But sometimes we will find rectangles which have a fairly larger range, where we can use it to trade not just the breakout, but also the range. But in this case, we're probably looking at it from trading the breakout perspective.